Good morning, students. I hope all of you are doing well. And today we will start with the day 4 of India's 115. In case you have any doubt on whatever we have completed so far, please feel free to ask. You can put it down in the comment box. And we'll continue from where we left yesterday. And let me share the screen. So yesterday we spoke broadly about the step 5, where we spoke about how the performance obligation is transferred and all of that. Now, as we discussed, one very important aspect that we need to keep in mind is whenever there is a performance obligation which is satisfied over time, okay, we will use some method to estimate what percentage of work has been completed. So we have some method called input method, we have some method called output method. Now in input method, what happens, you will see how much was the expected input. For example, number of hours, total cost to be incurred. So what is the cost incurred versus what is the estimated cost. Output, what is the current output divided by what is the total output. So based on this, we will estimate what is the percentage of transaction price that has to be recognized as revenue. So when it is satisfied over time, these are the two methods. Generally, we'll prefer input method. Now, under input method, sometimes what happens is, let us say there is a contract to construct a building. Contract to construct a building. In this building, we need to provide some kind of lift, and this lift is a standalone equipment which the entity, the supplier, they purchase that equipment and they deliver it to the site. So the lift cost is also included in the contract, but as far as this lift is concerned, the entity is just acting as an agent. For example, the supplier or the customer was supposed to purchase the lift. What the customer said, I don't want to get into all of this headache. You only purchase the lift, you only deliver the lift to the site. Okay. So here the entity is just acting as a transitionary agent. He may have purchased, but immediately after purchasing, the lift has been delivered to the site. Now, say for example, this lift was costing 40 lakhs and the total contract price is 100 lakhs. And let us say on day one itself, the entity purchase this lift and deliver to the site. Now, this, if you see, it will represent 40% of the cost. And if I start accounting that, okay, I have completed 40% of the cost, I have completed 40% of the contract, and let me recognize 40% of the revenue, that may not be appropriate, because if it was without the lift, it was 60 lakhs, the transaction price, and no other cost has been incurred. No other cost has been incurred. Only lift has been purchased and delivered. Just because you have purchased the lift and delivered, you should not be recognizing revenue immediately, right? The reason being, it will unnecessarily show you a higher contract completion, right? So what the standard says is, in such cases, there are some specific criteria. So whenever there is cost that is not proportionate to entity's progress in satisfying its performance obligation. I just purchased the lift and I delivered the lift at the site. Now, just by delivering the lift at the site, I have not installed the lift, I have not constructed the building. I should not say my contract is completed to the extent of, let us say in this example, just for argument's sake, 40%. So what the standard says is, you need to adjust the input to recognize revenue only to the extent of cost incurred. Now, when do we do that? In case of the following 4 conditions being satisfied. Number 1, the goods do not represent a distinct performance obligation. So just by buying the lift and delivering it to the site, it is not a performance obligation completed. You have to install the lift. Customer is expected to obtain the control of the goods significantly before receiving the service. The lift was received much in advance. Construction service has not yet happened. Cost of good is significant relative to the total expected cost. The lift cost is significant. and the entity procures goods from a third party and does not significantly involve in designing and manufacturing the goods, even if the entity is a principal arrangement between the entity and the end customer. So I purchase the lift, as it is I deliver it to the site. I am not involved in customizing, designing and all of that. So in such kind of scenario, we have to adjust the input method. Now this we'll understand better with an example. So let us look at this example. I took the lift example so that you can now correlate it with it side by side. Yeah. So this is illustration number 65. On January 1 of year 1, an entity contracts to renovate a building, including the installation of new elevators. So here on the building elevator, the entity estimates the following with respect to the contract. Number 1, transaction price 50 lakhs. So transaction price is 50 lakhs. Expected cost, elevator 15 lakhs, other cost 25 lakhs. So total cost is 40 lakhs and you are expecting a profit of 10 lakhs. The entity purchases the elevators and they are delivered to the site 6 months before they will be installed, and the entity uses an input method based on cost to measure the progress towards completion. The entity has incurred actual cost of how much? 5 lakhs, right? So this is the summary of the question. I've just noted them here. Now what happens here is this 15, this is delivered. Did the entity incur cost? Yes, the entity incurred cost. But just by delivering the elevator, it has not completed a performance obligation. So if what happens? If you say that cost is 15 elevator plus 5 other cost, 20. Out of 40, it is 50% complete. If you do this, you will recognize 25 lakhs of revenue, and the standard says this is excessive because significant part of the work has not been done. Lift will be installed after 6 months of time, right? That is why you should not recognize, and you should adjust this 15 lakhs of cost of elevator to reflect what is the other cost, that will be incurred, and accordingly we should recognize the revenue. So what it says is, take 40 total cost, 15 is towards elevator, 25 is towards other cost. Out of this 25, how much have we completed? You have completed 5 out of 25. So this represents 20% completion. This is delivered. The 15 of lift is already delivered, right? Now, from the total revenue, transaction price is 50, out of which elevators cost, if you exclude 15, you have how much? 35. So what the standard says is, this elevator, you keep it aside. You think that transaction price is 35, of which 20% is 7 lakhs. So recognize revenue of 7 lakhs for other cost, and 15 lakhs, whatever is the cost of equipment that you have delivered to the site, you recognize this as revenue only to the extent of cost. So revenue will be 15 plus 7, that is 22. Basically, without completing the work, don't unnecessarily recognize the revenue. Otherwise, you would have recognized 25. But by separating, so the way you have to approach this is cost of that equipment, separate it from the cost and also from the transaction price. To the extent of cost, recognize revenue, and the remaining part, whatever is completed, you recognize revenue. Are we clear? Any questions here? Okay, no questions. Now, coming back. Some miscellaneous aspect. So far what I have done, we have understood the 5 step. Identify the contract, then identify the performance obligation, determine the transaction price, then allocate the transaction price to performance obligation, and lastly, recognize revenue. Please remember, whenever you have to recognize revenue, when you recognize, you have to see that there is a transfer of goods or services. Now, one more aspect, I think quickly I should inform that also. One more aspect, if there is, let us say, a gym which charges 5,000 upfront fee. Okay, 5,000 upfront fee for 2-year membership. Now the question here is, Should this 5,000 upfront fee be considered as revenue immediately, or should we proportionate it over a 2 years time? So this is an upfront fee, 2-year membership on a monthly fee. So what the guidance says is, if this 5,000 results in transfer of goods or services or satisfaction of performance obligation, then you will recognize it upfront. For example, I take a Tata Sky connection. The entity charges me 5,000 fee for delivering the set-top box, installation and all of that. So that is a performance obligation which is to be provided by Tata Sky, for example. Then I can recognize revenue. But if let us say Tata Sky says this 5,000 is not towards the installation or delivering of set-top box, that 5,000 is something like a non-refundable fee. It's like a non-refundable fee. Anyways, when I take the connection, they'll say, when you take this monthly connection, we will install all of that as a part of the contract itself. Then in that case, that may not be a separate performance obligation. Or if I just take the set-top box, or if I just take the connection without the set-top box, I will not be able to use it, right? So the connection and the set-top box, they are very much integrated, and you may not be able to separate those performance obligations. But otherwise, let us say you take a gym membership upfront fee. For that 5,000 rupees, they'll give you the gym costumes, the shoes and all of that. Then that 5,000 may be related to those aspects, and if that performance obligation is satisfied, then you will recognize revenue immediately. Now if you say that no, this 5,000 does not involve any performance obligation, there is no transfer of goods or services, then in that case this 5,000 will also be apportioned over the contract period as a performance obligation satisfied over a period of time, right? So there is one more aspect you need to keep in mind. Now moving on, miscellaneous aspects. First one is contract cost. Now when you say contract cost, there are two costs. Cost to obtain a contract, we call it contract acquisition cost, and the other one is cost to fulfill a contract. Okay, so there are two aspects. Now if there is a contract acquisition cost, means I have to obtain a contract, I have to enter into a contract with the customer, so I have to incur some cost, maybe salesperson salary, some advertisement expenses, some cost, or some legal fees, or stamp duty for entering into a contract, or I have to pay brokerage. So something or the other I will incur. Now how do we recognize it? If contract cost is incurred, whether or not the contract is obtained, meaning to say whether you obtain the contract or not, you have to incur the expense. For example, salesperson salary. If salesperson salary you incur, whether or not you obtain the contract, immediately recognize as expense. So whatever are there, if you mandatorily incur, even with or without the contract, you have to recognize it as an expense. But if there are incremental cost, then how do we recognize? You will recognize it as an asset if the incremental costs are expected to be recovered. For example, there is an incremental cost by way of, let us say, stamp duty. For example, you have to incur 10,000. This will be incurred only if you get the contract. Now, if you can recover this contract, or if you are saying that I will recover this money from the customer, then you will recognize it as an asset and you will amortize it over the period of that asset. Sir, what is the meaning of recovering this 10,000? Basically, we are saying we will make a profit in that contract. Only then you will recover, right? Otherwise, you will not be able to recover. So, unavoidable cost, expense; incremental cost, asset if you expect it to be recovered. If you expect that you will recover. If not, then you will recognize it as a loss. So, some examples. Commission paid upon successful signing of the contract. Now this will be paid only when you sign the contract. So if you sign the contract, you will capitalize that yes, the entity expects to recover the cost and the commission is incremental, and hence you will capitalize. Okay. Just a second. Yeah. Then travel expenses for salesperson. So I have a salesperson, he will travel from one place to another. That expense I will not be able to capitalize, because whether or not I get an order, I have to incur that expense. So this will be expense. Legal fees for drafting terms of arrangement for parties to approve and sign. So you have drafted it. Now you have already incurred that cost. Subsequently, contract may not be entered into. So you will expensive. Salaries for salespeople working exclusively on obtaining new client, again expense. Bonus based on sales target. Now that is only incurred if the contract is achieved or if contract is received. So capitalize. Commission based on to pay to sales manager based on contracts, again capitalize. Right. Then So one is cost to acquire a contract. Whenever I'm entering into a contract, what is the cost that I've incurred to acquire the contract, right? Then second part is cost to fulfill a contract, which we call it as contract fulfillment cost. Contract fulfillment cost means the expenses that we incur to satisfy those performance obligation. They are called contract fulfillment cost. Now, if such contract fulfillment cost is covered under another standard, for example, inventory, you will account for it as per that particular standard. If it is not covered under any other Ind AS, then you will recognize those costs as an asset. We call it contract asset. If it doesn't meet the inventory related criteria, in most of the cases it meets. If it doesn't meet, then you will recognize the cost as an asset if the cost related to the contract, cost generate or enhance resources of entity that will be used to satisfy the performance, and entity expects to recover the cost. A simple example could be, let us say there is a building contract, land belongs to customer, and as in when we construct the building, the customer obtains control. When the customer obtains control, I will not recognize that as an inventory because I am not selling inventory. I am providing a construction service. Now there I have incurred a lot of cost. So that I will recognize as a contract asset. So I will recognize as a contract asset whatever is the cost which is directly related to the contract. Number one, the cost has to relate to the contract. So all the cost of material, labor and all of that. Then cost generate or enhance resource of an entity that will be used to satisfy the performance obligation. And lastly, the entity expects to recover the cost. So if you expect the recovery, you will recognize that as a contract asset. Subsequently, when you receive a right to, or when you obtain a right to receive the payment, we call it unconditional right to receive the payment. For example, I have started construction work. Once it is 20% complete, I have a right to receive 20% of the amount. Once it is 20% complete, I have right to receive that amount. In that case, I will say receivable. Till the time there is no right to receive, I will say contract asset. Once I have established a right to receive, I will say it is a receivable. Okay. Now, think of it. I have incurred cost of 100 and I have an unconditional right to receive 70, for example. So, this 70 will be receivable, 30 will be contract asset. 70 will be receivable, 30 will be contract asset. Same way we may have contract liability also. Customer paid in advance. Customer paid in advance. We have not yet performed the work. So that will be a contract liability. Then the following cost should be expensed as incurred. So the cost, so one is if it is covered under any other standard, for example, inventory, PP and all of that, you will account as per that. If it is not covered under any other Ind AS, for example, construction related work, you will account for it as a contract asset as per based on these conditions being satisfied. Then the cost which should be expensed always is the general administrative costs that are not explicitly chargeable to the customer, my accountant salary, my corporate office expenses. So these kind of things you will also see in Ind AS 2, Ind AS 16, Ind AS 38, general administrative expenses. Then wasted material, labor or other resources, same thing. Then costs that relate to satisfied performance obligation, means performance obligations have been satisfied. Now when the performance obligation has been satisfied, we will recognize revenue. So the cost also should be recognized. And then costs related to remaining performance obligation that cannot be distinguished from the costs related to satisfied performance obligation. If you cannot distinguish and if there is some kind of challenge, that also you will, expense it off. Then amortize capitalized contract costs on a systematic basis consistent with the pattern of transferring goods or services. So generally, the way in which you complete the contract or recognize revenue, in the same way you will amortize those expenses. Okay. Then if there is an impairment loss, you will recognize. Then again, impairment loss, if it is to be reversed, you will do that. So impairment related thing we will understand when we go to Ind AS 36. Right. So that is contract related aspect. So two things, sometimes you may get a question in the examination, contract asset or a contract liability. So what you need to understand here is, if the cost incurred is greater than amount billed or received or receivable, then it will be an asset. If amount received is greater than the cost incurred, then it will be a contract liability, or as a revenue recognized, then it will be a contract liability, right? So you may have to write, for example, I collect 10,000 from each of you. Initially, in fact, this there was an idea. So 10,000 I'll collect from each one of you. Now, if I collect 10,000 from each one of you, and I say I'll provide you services for 12 months or 10 months period, okay. Now, and let us say on 31st of March, 6 months are completed, 6 months are left. So what I will say, 5,000 is my revenue, 5,000 is my contract liability, because I have received the money in advance. So then that balance 5,000 which I have received in advance, that will be called a contract liability. So if in the contract it is mentioned that the entity has to bear the rental charges of warehouse and seller can recover that rental expenses through the selling price, how do we account for it? See, then if the contract mentioned that the entity will bear the warehouse, so that is my rental expense. So rental expenses I'll account as per my lease related standard. Whatever amount I have to recover, that I will account for it as per Ind AS 115. Now there could be multiple scenarios possible. First scenario is it is a reimbursement. If it is a reimbursement, then I will not account for it as a cost or expense. I will recognize it as an asset. For example, I spent 5,000. Customer will pay 5,000. It's a reimbursement. So this spending amount will be my asset. So I'll recognize it as a receivable and not as my expense. Okay. Now, if it is included, now we have to see the terms and conditions of the contract. Generally, if you ask me, if I have a shop and I incur rental expense, of course I will recover it from the selling price. Of course, the customer will pay that amount to me. Otherwise, I will incur loss. Correct. But that spending is for general warehouse for me. I am incurring that cost. I will recover that cost also. But that is a general spend for me. May not be identified to a specific customer. So in that case, this will be expense. You will treat the rentals as per Ind AS 116. And whatever amount you collect from the customer will be a part of your revenue. But if there is a specific asset, where you say clearly this rent will be reimbursed by the customer as a part of the contract price, then that part you will not recognize as an expense. That part you will recognize as a an asset to be recovered from the customer. So you have to look at the terms and conditions of the contract to see whether it has to be an asset or an expense. Any other questions so far? Now, some other important matters that we need to be aware of. Warranties. Now, all of you, when you buy mobile phones and television, electronic equipment, you get warranty. Now, there are two types of warranty. Now, what are these two types of warranty? One is called the assurance type warranty, and the other one is called service type warranty. One is assurance type warranty, and the second one is called service type warranty. Assurance type warranty is by default it is given as a part of the product. So when you buy, you get a 1-year warranty. That 1-year warranty you don't purchase separately. That is assurance. But sometimes what you do, this warranty you can purchase extended warranty separately. So 1-year warranty plus, most of them sell, no? Sir, take this 2 years extended warranty, 500 rupees only. Correct? This is an extended warranty which can be purchased separately. So there can be a separate purchase option available, or there may not be a separate purchase option available. Now, if the option is not available to purchase separately, for example, I have a phone. Okay, I purchased the phone. Now, the warranty is combined with the phone and that cannot be separated. You cannot say, keep the warranty with you, give me a discount. Okay, or you would not even want to say that. Otherwise, if something goes wrong, then what will happen? So, you have taken the phone, warranty is a part of the phone. You cannot purchase that warranty separately. There is no option available. Okay, and in many cases, the government regulations and all require that you have to give this much amount of warranty for some products. For example, let's say the government says 6 months warranty should be given for mobile phones, right? So The 1-year warranty is which is an assurance type warranty where you are assuring the customer that if something goes wrong, I will repair the product, repair the defective part and all of that. This is not a separate performance obligation, and this will be accounted for under Ind AS 37 as per warranty provisions. So when we go to Ind AS 37, there we will understand how to account for it. A lot of you would have already learned in AS 29 as well. Expected warranty cost will be recognized there. Then, if you have an option to purchase warranty separately, then that is a distinct performance obligation. This is a distinct service and a separate performance obligation, and whatever is the amount you collect, you will say, okay, for example, I'll just write here. Cost of phone, 10,000. Extended warranty 2 years, 1,000. Total amount you paid is 11,000. Standalone selling price is 12,000 and 2,000, 14,000. And this also comes with 1-year warranty. Now, what you have to do is, as per how we have done the transaction price allocation, this cost of 10,000, cost means when I am saying cost, not the cost of the product, selling price. I'll put it that way. Not the cost, actually the selling price of the phone, 10,000. Extended warranty, they have collected 1,000. Total amount collected is 11,000. This is your transaction price. Independently, if you buy, 12,000 and 2,000 is what you need to pay. So this 11,000 should be allocated as 11,000 into 12 out of 14 and 11,000 into 2 out of 14. This you will recognize revenue the moment the product is sold, is handed over to the customer. This you will recognize as revenue over the 2-year period. 1-year warranty, you will say there is a cost, expected cost to be incurred, which I will account as per Ind AS 37. Are we clear? Now, some factors, if the warranty is required by law, it is not a separate performance obligation. If it is a longer warranty period, it may be a separate performance obligation. Then you have to check what kind of task the entity performs. If there is no separate performance obligation that is being created, then you will say it falls under the first category. Now, if it is not a separate performance obligation, this category. If it is a separate performance obligation, this category. Any questions? Okay. Now, I just need a confirmation, clear or not clear, so that I can continue at the pace. Okay. Then sometimes there are customer options for additional goods or services. Now, additional goods or services, for example, in IndigoLearn also, you purchase any product, 5% iCash will be provided to you. Sir, what do I do with 5% iCash? You use it in the subsequent purchases. In the subsequent period purchase, that 5% will be adjusted. Or I come and tell you, if you purchase FR, I'll give you 10% additional discount on SFM, right? So there could be multiple things, where the customer has options for additional goods or services. Now, if such option provides a material right to the customer, material right to the customer means what? The material right is, for example, I give you a discount because you have purchased FR. That discount is not available to anybody else who has not purchased FR. So, if the right is material, if it results in a discount that the customer would not receive without entering into the contract. So, whether the right is material or not, you need to decide. Okay. If the right is material, then the option is treated as a separate performance obligation. But if I tell you generally, whether or not you have bought FR, you will get 15% discount on SFM. Now, in that case, I am not giving you any material right. Everybody else gets that right. Hence, that will not be a separate performance obligation. Now, this we will understand better with an example. So, let me just put up the screen here. Yeah. An entity enters into a contract for the sale of product A for 1000. As a part of the contract, the entity gives the customer a 40% discount voucher. So let me just note down here. So product A is for 1000. Then you get a 40% discount voucher on any future purchase up to 1000. Up to 1000, whatever you purchase, you will get 40% discount voucher in the next 30 days. The entity intends to offer a 10% discount on sales during the next 30 days. So, general offer is 10%. General offer is 10%. The 10% discount cannot be used in addition to the 40%. So, if you have 40%, you will of course use 40%. The entity believes that there is an 80% likelihood that a customer will redeem the voucher on an average, and on an average the customer will purchase. Sorry, my pen went back. Just give me a moment. The entity believes that there is an 80% likelihood and to redeem the voucher, and on an average, a customer will purchase 500 worth of additional goods. Determine how many performance obligation does the entity have and their standalone selling price and the allocated transaction price. So this will actually help us understand whenever a customer has a material right to additional goods or services, then how is that to be handled. I'll just need a 2-minute pause till the time the pencil gets charged, and then we'll continue. In the meanwhile, if you have any other questions, any general questions, preparation related aspects, you can ask in the chat box, and I'll try to answer them. How many of you are on examination leave already? No one? Okay, Nivedita is on examination leave. Good. Others? Saisham is also on examination leave. Okay. So I hope you are making the best use of your examination leave time. Just a moment. Vishnu is on leave, Kanishka is also on leave, RG is also on leave. Good. So are you able to pull up the requisite number of hours per day, whatever you thought you will do per day on a daily basis? So finally it's here. Sometimes technology. Okay. Yeah. So good that you're able to pull up the time. 80%, 500 per day. 500 per customer. So for those of you who are not able to pull the specified number of hours, keep small targets on a weekly basis. Take 7, 8 hours, 9 hours per day. Decide tomorrow before going to bed on the previous night. Decide I will complete these many hours or these many chapters the next day. Don't try to make a 3 months plan and then suddenly you are like, I'm not able to do anything. That will create a lot of burden on you. So take small tasks, 7 days at a time, Monday to Sunday. This is the time, and on Sunday you can do a review. And please practice the daily introspection every day. That will definitely help you improve the time that you are spending on studies. Okay. So now coming back to our thing. So here, if you see, product A is sold at 1000. Product A is sold at 1000 because you have purchased product A. Because you have purchased product A, you get a 40% discount up to 1000 rupees of purchases. And generally, the customer expects that 500. A customer will purchase 500 additional, items. Right now, the question is how many performance obligations are there in this particular case. Now here, product A is one performance obligation. Delivering product A is one of the performance obligation. Then this 40% discount is another performance obligation because it is being provided to the customer. But now, should I say it is 40% obligation or 30% obligation? Should I say it is 40% obligation or 30% obligation? 30% because 10% I'm providing to everybody. So additional 30% becomes my obligation. Now what you have to see is, I gave product A with a standalone price of 1000. I am giving discount. Sir, at what price or what value discount I am giving? I am giving discount of 30%. And this 30% is on a product value 500. And I expect 80% usage, means 80% of them will use. So 80% is the probability. 500 into 30% is 1500, 150 into 80% is 120. So basically what the standard says is, you are not only giving product worth 1000, you are also giving a additional material right worth 120. So there are two performance obligations, 1000 and 120. But how much did we collect from the customer? We collected only 1000. So product A and the discount, we collected totally 1000 because the customer has not paid us 1000. But by paying us 1000, he gets an additional material right of 120. So the standalone price 1000 and 120. How do we allocate? So this is 1120. The amount that you have collected, you will say 1000 into 1000 by 1120. 1000 into 120 by 1120. This is how we allocate the transaction price. Okay. Now when you account for it, bank 1000 to revenue, whatever the number you get. So 1000 into 1000 divided by 1120, you get 892. 892. So 892 will be revenue, and the balance amount 108. This will be a liability. Now this liability of 108, this will be recognized as a revenue subsequently when the customer purchases the item, okay, or the discount voucher expires. So that is how we handle the aspects related to material right. Now, as far as long-term arrangements are concerned, generally these happens in case of services provided over a period of time or continuous supply of goods or services. Then the accounting principle generally doesn't change. So whatever we have been doing, for normal thing, that the same thing continues. Okay, so whether there is a single performance obligation, multiple performance obligation, it doesn't change. Then we have consignment arrangements. Now in consignment arrangements, we have principal and we have reason. If the customer doesn't excise, then you will recognize it as revenue and take it to P&L. If the customer exercise also, you will club it with the other transaction price and take it to the P&L. Okay. Principal and agent is there. Principal consigns goods to the agent, control is not transferred. When the agent sells to the customer, then control is transferred. So principal will recognize gross revenue or total amount of revenue when the agent sells it to the end customer. And when the agent sells to the customer, he will recognize his percentage commission. Okay, because the principal controls the product till the time the agent sells the product. Then revenue is recognized on gross basis and on net basis. Simple thing, but they may test it in the examination. That is also there. Now, indicators that the entity is principal. Some of the indicators that entity is primarily responsible for fulfilling the contract. Entity has inventory risk before the specified goods or services has been transferred to a customer or after transfer of control to the customer. So basically, if the inventory risk is with the principal, then he has the risk and the control has not been transferred. And the entity has discretion in establishing price for the goods or services. In that case also the principal has the thing. So the consignor will recognize only when the consignee sells it to the end customer. Then non-refundable upfront fee. If it relates to goods or services which an entity has to provide at the inception and it is a separate performance obligation, recognized immediately at inception. So I gave an example. If, for example, I supply gyms, shoes and costumes and all of that, then you will recognize immediately at inception. If it does not relate to goods or services, then I will recognize over the period when the performance obligation is satisfied. So here also one question we can discuss, which will help us understand. Non-refundable upfront fees. Customer buys a new data connection from a telecom entity. It pays one-time registration and activation fee at the time of purchase of the new connection. Now here we are paying one-time registration and activation fee. The customer will be charged based on uses of data on monthly basis. Are the performance obligation under the contract distinct or not? Now here, if you see, when a new connection is sold, the entity promises to supply data services to the customer. Customer will not be able to benefit just by buying a data card or data services from a third party. So, just by buying a Wi-Fi router from a third party, I will not be able to get the benefits without paying this activation and all that fee. In that case, it is not a distinct performance obligation, and hence you will combine the performance obligation, and what you will do is, whatever the amount you pay as one-time registration, let us say 1000, and let us say that 1000 the entity expects on an average will be used by the customer for over a period of 2 years. That 1000 will be recognized as an income or revenue over a period of 2 years. So the key criteria here to decide is, when the customer is paying that amount, is the entity transferring some goods or services, or is there any performance obligation or not? Separate. If it is a sales based or usage based royalty, if it's a sales based or usage based royalty, you will recognize revenue for sales based or usage based royalty as and when either the sale happens, or the performance obligation to which some or all of the sale based or usage royalty has been allocated has been satisfied. So sales based or usage based royalty means, for example, I have a brand. My brand is, let us say, Jockey. I have given this brand to the other person to use it. I have given the brand to other person to use it, and there I am saying that payment has to be based on sales. So the other party will pay me amount based on sales. It is not like the thing what we discussed in the previous session, where we have intellectual property and there is a right to access or there is a right to use. Here it is about the sales happening, and based on the sales, royalty will be paid to the company, to Jockey. Now if the subsequent sale happens, royalty becomes due, and hence you will recognize revenue. Or if there is any performance obligation to which all of the sales based or usage based royalty has been allocated, has been satisfied. So if there is some other performance obligation on which the sales based royalty is, for example, supply of raw materials to the customer, to the customer who will manufacture the product, and it is linked to the royalty is also linked to that, or the usage based royalty is linked to that particular item, then in that case, as and when the sales based or usage based royalty performance obligation is completed, then you will recognize revenue. Normally it will be based on the sales or usage. So a lot of time you would see that brands like MACD, Domino's and all of that, they'll say you pay us monthly fee of this or monthly rental of this, and apart from that you also pay us 5% on sales or 5% on your usage, and accordingly they will charge the consideration. As and when the consideration becomes due, the entity will recognize revenue. Presentation disclosure you can go through on your own. It is pretty simple. The most important part, again, slightly complicated when it comes to service concession arrangement, where again you need to have absolute clarity on how to handle these questions. Okay, this has been tested as it is from the study material. So this is a part of the appendix. Now, what is the sales service concession arrangement? Service concession arrangement. So generally, if you see roads being built, right, you have something called a tolling company who builds and operates the road. So the road, when the road is built, let us say there is a tollway company. Whenever you travel from one place to another, you would see this toll plaza, you would see some name. Let us say, this particular place, Tollways Private Limited, L&T Tollways Private Limited, L&T Karnataka Tollways Private Limited, something like that. You would see a tollway company. Now, the tollway company, what they do is they build the road, they operate the road, they maintain the road, and they may subsequently transport the road. Now, the land on which the road is built is controlled by the government. So, even though we are constructing the road, we have a right to operate the road. This cannot be a PPE item, because we cannot say this is my road. I cannot say this person cannot travel. That is a public road. See, for using the public road, the public will pay fees, but I don't have a right. See, when I say I have a control or right to control a particular asset, I can avoid other persons from using that asset. But in this case, the company doesn't have, and hence PPE cannot be recognized. Now, here there are two types of things possible. These tollway companies are called concessionaires. A very typical word, because they are getting some kind of concessions, and the government generally is the grantor who grants the concessions. Okay. Now, the company has a right to construct, build, operate, and then subsequently they will transfer it back to the government. And public, you and me, whenever we have to use the road, we have to pay something called as toll fee. Okay, this is the typical structure. Now, the tollway company may get two types of payment. One is a consideration for construction or operation, and this is an unconditional right. Other one is public toll fee. So there are two things. One, I will receive, for example, the government says we will pay you 1,000 crores. We will pay you 1,000 crores. Then you charge 50 rupees per person or per vehicle, for example, from the public. So this is a typical service concessionaire arrangement. The typical service concessionaire arrangement where there is a consideration which can be lump sum, and there is a toll fee that you collect from the public. Now, this toll fee does not represent any unconditional right. See, when I say there is an unconditional right, what I mean is the entity has a right to collect. The entity has a right to collect that amount, and the entity will establish a receivable. So if government says 1,000 crores, after completion of the contract, the government will pay 1,000 crores. So this 1000 crores is what is an unconditional right. Here, toll fee is not an unconditional right, because toll fee will be paid only when the public accesses the particular road, right? Now, how do we account for it? If the consideration by the grantor to the operator is the one who is building and operating and transferring, if it is an unconditional right to receive cash or another financial asset from the grantor for construction of an asset and then operating it, then you will recognize a right to financial asset. We will take help of Ind AS 109. We'll take one example and we will see how do we do that. And if there is a right to charge users of public services, which is not an unconditional right, then you will say I have an intangible asset. So why intangible asset? I spent money to build an asset. Now that asset gives me a right to collect fee from the public, and hence I will recognize that as an intangible asset as per Ind AS 38. Okay, so this is the summary of how you do the accounting for it. Now I will share with you one question. See, a lot of this discussion is, the theory is not much relevant for you if you have understood how to handle the question. Yeah. Mark it as important. Please complete this before you go for the examination. A Limited is in the business of infrastructure and has two divisions under the same: toll road and wind power. The brief details of these businesses and underlying projects are as follows. Bhilwara Jabalpur toll project. The company has commenced the construction of the project in the current year and has incurred expenses aggregating. So let me just note them down simultaneously. Bhilwara Jabalpur toll project. Okay, and expenses incurred is 50 crores. Under IGAAP, the company has recorded such expenses as intangible assets in the books. So it is recorded this as intangible asset. We will see what are the other details given. Total expenses estimated. Estimated expense is 110 crores. Fair value of construction service is 110 crores. Total cash flows guaranteed by the government under the service concession arrangement. Cash flow guaranteed is 200. Finance revenue 15 crores. Other income relates finance revenue over period of operation. Other incomes relates to the service provided during the operation phase. Now here the question is, how do we account for this particular tollways? So, this is the summary. Bhilwara Jabalpur tollway, already expenses incurred 50 crores. Estimated total expense estimated is 100 crores, and fair value of construction service is 110 crores. Guaranteed cash flow is 200. Finance income, that is the company expects, is 15. Now, first, when the cash flow is guaranteed, the company has a right to receive this 200 from the grantor or the government. The operator has a right, because see, when there is a guarantee, even though public may use it, there is a guarantee that the government will pay 200 to the customer. Okay. Now, when 200 is paid, with the cash flow is guaranteed, can I say 200 is my financial asset? I cannot say. Whenever we talk about financial asset, financial liability, which we'll understand under financial instruments, the financial asset is recognized at fair value. So, the right to receive, which is a financial asset, you will debit by fair value, which is 110, and correspondingly you will say revenue 110. Okay, so financial asset 110 to revenue 110. Then number 1, cost of construction, which is your P&L item, debit. How much? I think I wrote it incorrect. Just let me check that. 100, this is 100. So 100 will be your cost to payable or bank as and when you incur 100. Then the question also talks about finance revenue. This is nothing but your, whenever you recognize a financial asset, you have something called as an interest income. For financial assets, we'll understand measured at amortized cost method, you will have financial income. So that revenue, you will add it to the financial asset of 15 to finance income 15. Okay. Now, the cash flow guaranteed is 200. Think of this. Cash flow guaranteed is 200. Out of this 200, 15 is my interest income. 15 is my interest income. So I am left with 185. Out of 185, 110 is the fair value of construction service. So 75, whatever is left over, this will be my revenue for the operating part. Okay. So that is how you will recognize or you will record the transaction. Now, 2-3 things here. First, the total cash flow guaranteed. Oh, I'll show you in the notes itself. Whenever there is an unconditional right to receive cash or another financial asset from grantor for construction, then you will recognize the right to financial asset. Correspondingly, you will recognize revenue. Okay. If there is a right to charge users of public service, then you will recognize it as an intangible asset. In this case, in the first case, there is a guarantee of 200. There is an unconditional right to receive that cash flow. Whatever is the construction services completed, the fair value of 110 is recognized as revenue. Whatever is the operating services, as and when it is completed, you will recognize revenue. Okay. So now, if you see here, the aspect covering two aspects. Operating and construction. So construction we said 110 is the fair value. 15 we say is finance income. And 75, whatever is left over, is my income related to operation. So as and when I complete the operating activity or the operation of the toll road, I will recognize the revenue based on the progress or operations conducted. Okay. Now let's look at the second part. Kolhapur-Nagpur Expressway. The company has also entered into another concession agreement with Government of Maharashtra in the current year. The construction cost is 110 crore. Fair value of construction cost is expected to be 200 crores. The said concession agreement is a toll-based project and the company needs to collect the toll from the users of the expressway. So here you have to collect toll. Under IGAP, UK Limited has recorded expenses incurred on the said project as an intangible asset. Now, here also in the second case. Now, what would be the classification of Kolhapur-Nagpur Expressway toll project as per the applicable Ind AS? In the case of Bhilwara-Jabalpur toll project, we said it will recognize a financial asset. In the second case, in case of Kolhapur-Nagpur Expressway, what we will do? We will say it is an intangible asset because we have a right to collect. We have a right to collect the amount as toll from the customer. We have a right to collect the amount as toll from the customer because I have a right to receive the money from the end customer. That right to receive the money, I am recognizing it as an intangible asset. Now, how should I recognize revenue? How does this entire transaction work? Now, think of this from the company's point of view. Your cost is 110. You have incurred that cost. Okay. Now, you have incurred that cost. Your fair value of the work that you have done is 200. Fair value of work that you have done is 200. Now, this fair value of work that you have done is basically your present right to receive, present fair value of right to collect. So I have incurred cost of 110. Today, if I see what is the value I will get out of that 110, that is 200. So my revenue will be 200. Now, can I say a financial asset? No, I cannot say, because I don't have an unconditional right. So I will say I have an intangible asset worth 200, against which there will be a revenue recognized of 200. Then cost, whatever cost I have incurred, that cost will be debited to P&L, the cost of construction, total expected cost 110, and to bank 110. Please remember, this is not a single day entry. As and when I incur the cost, I will charge it to P&L. As and when my progression completes, I have recognized this intangible asset, and because I have recognized an intangible, and I will start collecting fee from the customer. So see, because I have completed the construction, and I will start collecting fee from the customers, I will also need to recognize bank to toll revenue, and corresponding to this, I have amortization expense to intangible asset. So think of this entity government. Okay, entity government. Entity has provided what? Construction services. Entity has provided what? Construction services. For this construction services, the entity has incurred 110, and the fair value, the right that you will receive to collect the toll is 200. Okay. In other words, what the government is saying is, you have incurred cost of 110. In return for that, I am giving you a right to collect that construction service, whatever is there. I am giving you some right to collect, and the entity says, okay, that is having a fair value of 200. Indirectly, entity has given construction services. The consideration that it has received is 200, which is the fair value of the construction service. This 200 gives the entity a right to collect the toll. So there are two aspects. One, for providing services, they have received something worth 200. That is one aspect of revenue. And subsequently, as and when I collect revenue, as and when public uses, that part also I am recognizing as revenue. Then what is the cost for this? This intangible asset that I have received, I will depreciate that. Because I have given construction services, I have said, okay, government, I gave you construction services, you have to pay me 200. One option could be, government says, take this 200. Government says, take this 200. But what the government is saying, I'll not give you 200, I'll give you a right to collect, which the entity is saying, okay, I have a 200 worth of right to collect the toll from the customers. So if I have right to collect 200 worth of right from the customers, this I will recognize it as an intangible asset as a consideration. Subsequently, against that intangible asset, I will account for revenue as and when public uses the road, and I will amortize this. Now, some of you might be thinking, sir, is there double revenue accounting? No, this is an independent service of construction. This is a separate right to collect. So there are two dimensions to this particular part. Okay. So this is how you will account for these two transactions. Very important. What I will also do is, I've recorded few more examples which clarifies as to how the construction expenses and all of those will be recognized. So the entire set I will give it out as a YouTube clip separately. For those of you who want to understand more, can refer to it. From my live class, I'll just extract the portion and I will give it off to you guys. Okay. Any questions on this? Because this is something which is slightly challenging part. So any questions on this? Then we had one requirement of Jan 21 RTP. Jan 21 RTP. So let me just open that. So this is old new syllabus. Okay. I think I should have it. Jan 21. Oops. So somehow Jan 21 is not there. Just give me a moment. I'm not sure if we had Jan 21 RTP. It would be November 20 as well. Okay, so maybe after the session I'll get back to the student and we'll try to solve it, or I'll try to give out the solution separately. Any questions so far on whatever we have done? Now, okay, one quick tip for both Ind AS 116 and also Ind AS 115. There is a lot of content in the study material. It will be difficult to keep a track of. Okay, so how should we approach that? Let's say you want to revise it or you want to complete it. We have covered enough in the videos, right, from the examination point of view, and also a lot of conceptual thing. So what you need to do is, whenever we are looking at longer standards, because there is too much of text, and see, by remembering, if you remember 100% of the text, or if you revise 100% of the text, you may be able to handle it with 90% confidence. If you cover relevant, let us say 70% is relevant, then also you'll be able to do some 85% relevant. So you have to do it smartly. So what you have to do is, for Ind AS 115 and 116 and whatever standards you feel are lengthy, you complete our notes plus illustrations given in the notes or illustrations from the study material plus past papers. Theory part, don't try to overdo. A lot of students do that, because it's bulky, 150 pages, 3 modules. It will take a lot of time to understand and assimilate. Can you please refer the question, which are customer loyalty question? Okay, let me just see. I'll put it. Okay. So in this is how you should approach. Even when it comes to financial instrument or business combination or consolidation, these are larger standards, long standards. So take our notes, or if you have any other notes, I don't have any objection to use of any notes. Take the notes and complete the questions. Don't waste excessive time on completing the theory part. Okay, and once you have done this past papers, you can, all the past papers are compiled here, so you can just go to our app, and year by year you have this final new syllabus, financial reporting. We'll change the name, suggested answers. So all of these are here. Okay, so is this the question? So complete these questions. That will be sufficient enough preparation for your examination. So illustration 23 we completed. RG, which illustration do you want me to complete? Are you referring to illustration number 22, loyalty? Anybody has any other question? So in the entire standard of Ind AS 115, whatever you have covered, 5-step model, very, very important, that we have referred to multiple times. Then special cases like warranty, how is it handled? Variable consideration, changes in estimates of variable consideration, service concession arrangement, then right to additional goods, material right, whatever we discussed, right? So these are the key aspects where you have to have comfort on, right? And if you look at the study material, as I told you, lots and lots of text is there which may not be relevant and necessary. So we have tried to simplify the notes to the extent possible, which will be really helpful for you in the examination. Okay. RG, if you can share me the question number, I'll take it up. And anybody else has any other question to be asked, please feel free. I have some more time so before I end. So tomorrow we will not be having classes, Saturday, Sunday. This Saturday, Sunday, you should be able to complete the questions that we have covered for this particular chapter. Monday onwards, again, we'll have as per our regular time, 5:30 to 7. This week, because I have to take care of my daughter, my wife not being in town. That's why I'm restricting it to 6:45. Okay. So I didn't get the question which you are referring to. RTP May 19. That's how you have to tell me so that I can easily open it. Okay. So RTP May 19. Revision test paper RTP May 19. KK runs a departmental store which awards 10 points for every purchase of 500, which can be discounted by the customer for further shopping with the same merchant. So, definitely mocks you should definitely take. There is no doubt about it. There is no doubt about it. Okay, yeah. For further shopping with the same merchant. Each point is redeemable on any future purchase of KK Limited products within 3 years. So, each point you can redeem. Okay, like we give you, I guess, 1 year validity. During the accounting period, each value of each point is rupees 50. During the accounting period 17-18, the entity awarded 1 crore points to various customers, of which 18 lakh points remained undiscounted. So, 1 crore point has been awarded to the customers. 18 lakhs points remained undiscounted, means they have not yet been discounted or they have not been used. The management expects that only 80% of the remaining will be discounted in the future. Now, it's the same continuation question. The company has approached your firm with the following queries and asked you to pass journal entries under applicable Ind AS for the award point. How should the recognition be done for the sale of goods worth 10 lakhs on a particular day? How should the redemption transaction be recorded in the year 17-18? The company has requested you to present the sale of goods and redemption as independent transaction. Total sales of the entity is 5,000 lakhs. How much of deferred revenue should be recognized? Then, in the year 18-19, 60% of, sorry, how should the redemption transaction be recorded in the year 17-18? The company has requested you to present the sale of goods and redemption as an independent transaction. Total sale of the entity is 5,000 lakhs. Okay, so very huge numbers. Then in the next year 18-19, 60% of the outstanding points. Sorry, how much of deferred revenue should be recognized at the year end 17-18? Deferred revenue means the revenue which the entity is not yet entitled to. Okay, so how much of the total amount should be deferred? That is the next question. Then, In the next year 18-19, 60% of the outstanding points were discounted. Balance 40% will still remain outstanding. How much of the deferred revenue should the merchant recognize in the year 18-19, and what will be the amount of balance deferred revenue, and how much revenue the merchant recognized in the year 19-20 if 3 lakhs points were redeemed? So very comprehensive question. Good that you brought it. Right now, first thing, open it. So here, if you see, they award 10 points for every purchase of 500. So for 500 purchases, you get how many points? 10 points. Right now, each point is redeemable on any future purchases. That is fine. During the accounting year 17-18, the entity awarded 1 crore points. Now, if you see this 1 crore points, which year is this? This year is 17-18. How should the recognition be done for the sale of goods worth 10 lakhs on a particular day? Now, if you sell 10 lakhs on a particular date, 10 lakhs worth of amount, then how many points you will get? Divide by, for 500 you get 10 points, correct? 500 you get 10 points. So 500 into 10 is what you will get. So here you will get 0, 0 gone, 0, 0 gone, 1, 2, 3, 4, 5. 5 2s are 10. So 2 into 2, 0, 0, 0, 0. So you get 20,000 points. Now 20,000 points is what is recognized, correct? Now this point, value of each point is how much? Value of each point is 0.5. So 20,000 into 0.5, the value that you get is 10,000. Right? Value that you get is 10,000. Now 10,000 worth of points you are providing, that gives the customer a material, right? On a particular day, if I am selling on a particular day, if I am selling 10 lakh worth of product, I am saying I have given 10 lakhs worth of product and I have given 10,000 worth of points. I have given 10 lakh worth of product, I have given 10,000 worth of point. So this I will recognize as revenue as 10 lakhs into 100 divided by 110, because 110 110. No, sorry, not 100 divided by 110. It is 100 divided by 101. I don't have space. Just a second. Now here goods transferred are 10 lakhs. So I'll write 10 lakhs. 10 lakhs. Points given are 10,000. So the amount that you have collected on 10 lakhs, you will allocate them between this and this, and you will recognize revenue. Okay. Second, how should the redemption transaction be recorded in year 17-18? The company has requested you to present the sale of goods and redemption as an independent transaction. Total sales of the entity is how much? 5,000 lakhs. Now there are two things here. One, 17-18, total sales of the entity is 5,000 lakhs. Again here, what is the value of points? You determine that and present it separately. So out for this 5,000 lakhs, how many points are given? You split that between the revenue and redemption. Revenue and liability for redemption. Then in 17-18, the entity awarded 1 crore points, of which 18 lakh points are not yet redeemed. Out of which 18 lakh points are not yet redeemed. Now, the management expects only 80% of the remaining will be discounted in the future. So 1 crore points. 1 crore points. Out of this, 18th lakhs is not redeemed. So how much is redeemed? The amount that is redeemed is 100 minus 18. Out of 100 lakhs, only 18 lakhs is not redeemed. So 100 minus 18, what is redeemed is 82 lakhs. What is redeemed is 82 lakhs. Now, 82 lakhs is the discount, or 82 lakhs points will be used as discount for the company or when the customer purchases the product. Okay, so far is the calculation clear? Okay. So 82 lakhs worth of points have been redeemed in the current period. 82 lakhs worth of points have been redeemed in the current period, and the management expects only 80% of the remaining will be discounted in the future. So out of 18 lakhs, in the future only 80% will be discounted. So 18 lakhs into 80%, points that will be discounted is 14 lakhs 40,000. This will be what will be discounted. Means the balance 18 lakhs minus or into 20%, 360. This will not be redeemed in the future. Don't have a space, sufficient space. Just a second. Points redeemed is how much? 82 lakhs. Right. Now 5,000 lakhs was sold. 5,000 lakhs worth of product were sold. On this 5,000 lakhs, how much amount did we give as points? On this 5,000 lakhs, or I'll just write 5,000, how many points did we give? We gave into 10 out of 500, that is 0, 0 gone, 0, 0 gone, 100. So we gave 100 lakh points. This 100 lakh points have a valuation of 50 lakhs. So 50 lakhs, 5,000 lakhs and 50 lakhs. Sale point. How much should be the revenue? 5,000 out of 5,050 into 5,000. 5,000 out of 5,050 into 50. So 5,000 divided by 5,050 into 5,000, you have 4950.49. So revenue will be 4950.49. This is the revenue, and here it will be 49.50. This will be a liability. Okay, so this is for the sale part. Whenever you make that sale, that is how you will account for it. Now out of this 49.5, some revenue has to be accounted for in the current period. Sir, how much revenue should be accounted for in the current period? See, total points is 100 lakhs, correct? Total points is 100 lakhs. Now out of 100 lakhs, how much is carry forward? Carry forward is 18 lakhs into 80%. So 18 lakhs into 18 lakhs into 80%, carry forward is 14.4. Carry forward is 14.4. So how much is left? 100 minus 14.4, 85.6, right? 85.6 is what is left. 100 is the total point. Carry forward expected is 14.4. Carry forward, pencil went bad. Sorry. Just give a moment. My pencil gets getting recharged. So coming back, total points is 100 lakhs. That is the total points that you will. So we are in 1718. In 1718, 100 lakhs is the total point which has been earned. Out of this, what does the management say? The management says that 18 lakhs will be carried forward there undiscounted. Out of this 18 lakhs, only 14.4. I think I have done it correctly. 14.4 is to be carried forward. 14.4 will be redeemed next period. Okay, 14.4 will be redeemed next period. Now, how much points have lapsed? 18 minus 14.4, 3.6 are lapsed. So out of 100, 3.6 are lapsed, means total redemption will be for only 96.4. Total redemption will be only be for 96.4. Now out of this 96.4, how much have been redeemed? Out of this 96.4, so this is the total redemption expected. Out of the total redemption expected, 82 has been redeemed out of 96.4. 82 has been redeemed out of 96.4. And this 82 out of 96.4 is pertaining to 49.5. So whatever has been redeemed into 49.5, whatever is the amount that we have calculated, that amount will be considered as revenue when the points are redeemed. Okay. If you have any questions, you can ask. Then, so we take care of the second one. The third one. How much of deferred revenue should be recognized at the year end because of the estimation that only 80% of outstanding points will be redeemed. Now, how much should be deferred? Whatever we have recognized, liability of 49.5 minus whatever we have redeemed. That is 82 divided by 96.4 82 divided by 96.4 multiplied by 49.5. It is 42.10, 42.1 roughly. Okay. So balance part should be deferred. 42.1 roughly. Okay. So balance part should be deferred. 42.1 roughly. Okay. So balance part should be deferred. 42.1 roughly. Okay. So balance part should be deferred. 42.1 roughly. Okay. So balance part should be deferred. 42.1 roughly. Okay. So balance part should be deferred. 42.1 roughly. Okay. So 42.1 balance part should be deferred. In the next year 18-19, 60% of the outstanding points were discounted and balance of 40% of the outstanding points still remain undiscounted. How much of the deferred revenue should the merchant recognize in year T? Now, see, we have total points 18 lakhs which were deferred. They have deferred 18 lakhs, out of which 60% of the outstanding 60% of the outstanding points were discounted. So whatever is discounted, that is 10,800, 18% into 60% is 108. To that extent, we will recognize revenue considering the cumulative adjustment. So 96.4 is the total estimated. 82 we have already redeemed, plus 10.8 we will redeem now. Based on this proportion, you will recognize revenue and balance will be deferred for the subsequent period. Then, how much revenue will the merchant recognize in 1920 if 3 lakhs points were redeemed in 1920? Now, in 1920, if 3 lakh points are redeemed, whatever is the balance, see, in 1920, this will lapse. So, whatever is balance coming out from D to E, entire amount will be recognized as revenue. Okay. Now, this is the broad explanation of the question. You can have a look at the suggested answer. So I have covered till here in detail point number A, B and C. Point number D and E I have explained it because we are running short of time, and you can practice that using the suggested answer in the RTP. If you have any question, you can ask in the forums and I'll be more than happy to address them. Is it clear? Okay, next time, since request from my side is please share the questions in advance so that I can keep the questions ready. See, a lot of time got wasted in searching for the question, and whenever we had some gap in between, we couldn't utilize that time. Okay, so for that, please share it in advance so that I can keep the question ready and we can directly start discussing in whatever time we get in the between. Okay. Chalo, thanks a lot and have a nice day.